Good afternoon, everybody, and welcome to this, the last in our 2022 series of Professional Advisors Working Lunches. Today, we're partnering with our good friends at Schroders. And my name is Andrew O'Kelly with Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way. It'll ensure there's no background noise so our speakers can be heard more clearly. I should also inform you that this session is being recorded. As usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending you your proof of attendance along with a link to this recording in your inboxes tomorrow. And do please feel free to share this with your colleagues. Now, as we look back on this year, I think we can all agree that 2022 has been one of the most challenging years for financial advisors and their clients for the past decade. Many clients have seen a sizable dent in their portfolios over the past 12 months, and this shock has been exacerbated, of course, by the cost of living and fuel crises, due in no small part to the conflict in Ukraine. And it's at times like this that it serves us all well to take a really hard look at our businesses, check that we're running as efficiently as possible, and evaluate where the opportunities for growth will lie in the coming year. So with that in mind, what better time to take a look at the results of one of the largest surveys of advisors to be undertaken this year, and to present the survey results and shed some light on where the challenges and opportunities lie for advisors. In 2023, are Schroders Head of Intermediary Solutions, Gillian Hepburn, Alex Funk, who's CIO of Schroders Investment Solutions, and to take the view from the advisor community, a good friend of Professional Advisor, Unique Financial Planning's Managing Director, Philip Martin. So before we get into the meat of the session, let me run quickly through your learning objectives for today. At the end of today's presentation, you should be able to understand the views on the investment market in October, November, how they've changed and future predictions. We'll discuss the importance of ESG factors when selecting funds and clients' views on sustainable investing. And hopefully you'll understand the potential challenges in relation to wealth transfer, advisor fees, segmentation, and succession planning as we move into 2023. So that's me done. That's the CII and the CPD covered. Let's hear now from Schroders' Gillian Hepburn. Afternoon, Gillian.
Afternoon, Andrew. I'm delighted to join you as ever. To talk about survey. Alex Funk, CIO, is going to take the first couple of sections that we look at, but I just thought it was worthwhile setting the survey in a little bit of context just to get started. The survey series started back in 2014, so we've got some significant trend data now. This specific survey was conducted between the 18th of October and the 8th of November. Now, there's a bit of a history lesson, clearly, because that was a very interesting, challenging time for the government. I'm not going to ask everybody for what happened when, but essentially the mini budget was the 23rd of September. Kwasi was sacked on the 14th of October, so just before the survey started. Liz Truss resigned on the 20th of October. And then as we were doing the survey, Jeremy Hunt was in place, effectively reversing, if I could use that term, what had been agreed. So it was a really interesting time to be conducting the survey. And as you mentioned, it was completed by the largest number of advisors that we've seen before. So we're absolutely delighted. 439 advisors took part in the survey. So hopefully some really interesting data this morning that we're going to be able to share with you. So I'm going to hand over to Alex, who's going to start with how are clients feeling about their investments. So Alex, over to you.
Thanks, Gillian. Yeah, it's really good to be back. And I think, as always, we sort of start with the broader sentiment picture and seeing sort of sentiment deteriorate in the latter half of the year and most of 2022 when we compare to prior years, I think is not unexpected. I think we've had sort of rapid increase in inflation. We've had markets slowly continue to grind lower. We've had central banks continue to push interest rates up. We've had the increased correlation between bonds and equity. So having a sort of more bearish outlook, I don't think is too unexpected. I suppose the next question is then how does that then sort of move on to adjusting investment plans and so on. So we'll look on the next slide. What is interesting is to see that, yes, some adjustments have started to be made. I think it is interesting how interest rates will sort of feed through, because that's where consumers naturally will feel the pinch first, right? So as central banks continue to increase interest rates because of the cost of living crisis, our mortgage payments will go up, inflationary aspects on our day-to-day purchases start to go up. We tend to feel inflation less on bigger ticket items because we purchase them more infrequently. So we don't have a base effect as to what a car cost if we bought it 5 years ago versus now, even though those prices have gone up quite a lot for the sort of day-to-day purchases. So I think we'll see more adjustments on plans as we go forward, as some of the effects of 2022 really comes into play as well. And it would be interesting to hear some sort of Philip's views about that when we break a little bit later. But I suppose then moving on and taking this into account, what are people still most concerned about? And this rarely changes. And I think that's probably quite accurate, is that most people are always worried about capital loss. I think the reasons for why we're worried about capital loss changes. So clearly in 2022, you're really worried about capital loss because of the massive increase in volatility and the increased correlation between both fixed income and equity. So there were very little places where you could provide or create true diversification. What's interesting though is inflation concerns are coming off, right? So that sort of shows that some people are thinking about inflation from a sort of peak perspective as well. And so from a greatest concerns, you can see from May down to November, that trend is moving down. And that sort of makes sense, right? Because when you're faced with sort of 11% inflation, you sort of sit back and say, but how much higher can this go, right? And so that's the other thing. And then other aspects around rising interest rates. It was interesting to at this point in time that this wasn't a great concern, right? So again, it will be interesting from a sort of financial planning aspect is, are more people just cash buyers in the marketplace now? Are we just having less mortgage purchases, or has the effects of remortgage just not come into play yet? And I suspect we'll see a big sort of mortgage wall into 2023 when a lot of UK households will have to remortgage. And based on our current forward economic outlook, the Bank of England will have to keep rates higher for slightly longer to quell what would be quite persistent inflation within the UK market as well, due to sort of growth and energy mix that we have in this country. So if we move on.
So Philip, I just pause there at that point and just, Alex obviously raised this challenge around capital loss and then not such a focus on interest rates. Is that prevalent amongst your client base, do you think?
Well, it's obviously a very broad general question, and general market conditions will affect different clients in different ways. So if I'm far closer to retirement and I've already got a pot and I've got very, very little time to make it bigger, then inflation is going to be a bigger concern because I might not have enough to satisfy me in retirement. If I'm younger and I'm in accumulation, then you've got different concerns. And you could say the same about volatility in the market. If I don't need to realize it and I've got 15, 20 years to ride it out, it's of far less concern to me than if I'm going to have to start drawing down in the next 2 or 3 years. So I think we wouldn't make the same general observations because our client base is very broad across all of those different types. One other observation I would make is that higher inflation, I think it will start to feed through into different bits of planning over the next year, 2 years, certainly. And one of the big impediments, which I don't think is really talked about enough in the industry, is the inability of platforms, which are now the dominant force in savings, to index regular investments, something that was absolutely normal in life company days, that automatically regular savings amount would increase to keep pace with inflation. And that's going to be very, very hard to do now because people are naturally going to take any cash that comes back in order to fuel cost of living now. So we could start to sleepwalk ourselves into an ever worsening situation of under provision more generally across the next few years.
Yeah, it's a great point. I'm smiling as being an ex-life office person
who
remembers well auto-indexation.
And it just doesn't happen. So unless it's being picked up in annual reviews, contributions, even if they're one-offs on an annual basis, tend not any longer to be keeping pace with underlying cost of living increases.
Sure, and we thought it was interesting. Obviously, back in May, we asked, did advisors expect that some clients would have to adjust their plans as a result of the cost of living crisis? And the benefit of running your own surveys, you can then ask the next question, which in November we said, have they actually adjusted? And I think although, many have, our view, and I think Alex mentioned it, that's still to play out a bit more as, people still continue to come off fixed rate mortgages. So maybe they haven't felt the if I could call it, the pain of that yet. Fuel bills, whilst have gone up, this was the first week that we hit really cold weather. So again, maybe the fuel bill stuff again is going to increase. And then let's face it, we often all spend far too much at Christmas. So there's a number of different things happening, isn't there, in terms of having to adjust plans going forward. So we think that number will probably rise.
Yeah, I think, really to brass tacks, we have had a handful of clients whose retirement plans have now been put on hold. So it absolutely has affected their planning. They had retired to retire towards the end of this year or the beginning of next. That is no longer happening as they seek to take remedial action to get back on track.
Okay. So Alex, market trends, what did advisors tell us?
Yeah, I think so. So a really good starting point to start thinking about this is around asset allocation or exposure to various asset classes. And so the ones that sort of stand out during the last 12 months, so that's looking back during periods of really high volatility, increase in alternatives and increase in cash. So the sort of cash hoarding is, yes, we're nervous, markets are selling off, cash should keep us afloat. Less worried about inflation chewing away the value of my cash at this point, just one protection from drawdown. And at the same time, around sort of alternatives, right? I think it's been the first time in many decades where you've seen the correlation between fixed income and equity move to one so sharply. And so, cautious investors have been most affected here, where usually you would expect the bonds to provide some sort of buffer in your portfolio. That actually hasn't helped. And so in some cases, lower risk investors have lost more than higher risk investors, which is quite a strange way to think about risk, right? So I think the trends that we're seeing here is I'm going to sell things that have lots of risk, equities, corporate bonds, and I'm going to buy things of perceived safety, cash, and alternatives. But again, the markets are mean reverting, and so are we as investors. The concept of buying low, selling high works in most cases. So what you can see here is sort of the next 12 months trajectory is, yes, I still want to keep some of those diversifying assets that's treated me well this year around alternatives and so on. The markets are sold off a lot, right? 20, 30, 40%, depending on which month you choose as a snapshot and which asset class. So I want to add some risk into that. And I think that's a good reminder that markets tend to be forward-looking. I need to remind myself of this every once in a while as well, because I feel like we're so short-term focused. But markets do look through recessions and they do tend to price things ahead of that. And so I think that's sort of a clear indication. And I think that sort of the advisor community sort of agrees with that. So if we move on, we could look at some of the other things. So I think, lower bond market returns relative to long-term averages. I think, having a bearish view on bonds is a base effect thing. So, bonds have been a place, yields have been kept low by central banks for decades at a time. That all unwound very quickly in 2022. You went from basically zero rates in the US to we're talking about a terminal rate of 5%, right? This is a massive move. So anchoring off that basis to say, do I continue that trend to expect, I think is not completely unreasonable either. And that alongside sort of higher market volatility. And that's because we've experienced volatility across major asset classes. So I think we are going to move into a world where volatility is higher. And it's interesting, though, because volatility as a measure of risk just shows us dispersion of returns, right? It doesn't actually mean that you've lost anything. It just says how things disperse between the left and the right of an average. And so it just makes us feel uncomfortable. But we have to remember that to increase volatility, opportunities are created as well, because you will have buyers and sellers at those price points. So I think, yes, market volatility will remain higher. So I tend to agree with the theme there. I do think we mustn't forget that, opportunities are created off the back of these as well. So some of the other trends now we'll be looking at. just on the next slide. So I think, on the basis that inflation has peaked in such a fashion, specifically in the UK, and we've seen some rollover prints within the US, expecting inflation to come off from here is probably not too surprising either. Because again, if you would expect that, if you're at 10%, how much higher does 10% go, right? And so I think starting to sort of think about lower inflation, and we can see that specifically between the higher and lower inflation tipping points here. And again, from an interest rate perspective as well. The other interesting thing is, yes, that 2023 is probably the most forecasted recession that we've had on record, right? And our view is that 2023 will go into the developed world, at least, will go into a recession. The question still is around how deep that recession looks. But again, you can price forward. And so higher global growth up from our survey in May is quite clear that you can start picking up from the trend here as well. So again, there are shifts that a lot of the trends are sort of saying we are potentially moving into the next phase of this economic cycle, and more people are starting to sort of build the portfolios in that way and express their views from sentiment perspective as well. And then again, thinking about sort of broader trends, and this is probably not too unexpected either, around high disruption due to geopolitics. I mean, a lot of the problems we face today is because of war. And so, the energy security problems that we have is due to the invasion of Russia into Ukraine. And then again, in a similar fashion, the noise around China and Taiwan, I think all of that's created lots of market volatility. And so expecting that trend to continue, off the back of COVID, I think a lot of this is off the back of the COVID, obviously, where, we're talking about onshoring, we're reducing global supply chains. All of this results in a mix of potentially higher geopolitical sort of tension. And then the other one that's interesting is around environmental challenges. So again, we have seen, mass flooding, we have seen very cold temperatures. I mean, the videos that I saw about the M25 in the last 24 hours, I find, alone means that we can't cope with these environmental challenges, right? And so I think disruption continues with us going forward. So I tend to agree with this. And then the obvious one, which is technology, which we've sort of seen time and time again feature within the survey.
Yeah, thanks, Alex. Philip, does some of this resonate? I think the interesting one for me was this significant move to cash. I don't know if you have portfolios that have changed in that direction.
Yeah, I mean, I think again, we've got a relatively small number of clients who would be purely investment market timing sort of. I think the time is right to invest now. The majority of our client base would be doing it as part of a longer term plan. So expressing clear views about going overweight in cash or now being a buyer opportunity would be of less relevance to us. I mean, Alex picked up on a really interesting point. There are very, very, very few periods where both bonds and equities are positively correlated in the way that they have been. Although I think the follow-through statistic to that is that you can then very often have the best potential returns from both asset classes over the subsequent period after the correlation reverts back to where it is. So which all of which takes you back to basics, doesn't it? Of stick to your knitting, think about the longer term, don't panic, and whatever you do, don't get out of the market when it's depressed, stay invested. And that's been true. We'd have had minor adjustments to portfolios, but not a big swing to cash in perhaps in the way that number suggested.
Yeah, it felt kind of surprising. So many advisors will talk about this a long-term investment strategy, and it's a buy and hold, and then we saw this swing to cash. But
I think it is fair to say that we have lived through an extraordinary time where UK investors sitting with exposure 40-ish% to the UK sit and turn the news on every night for 2 weeks and discover that their government's crashed the economy. I mean, that's a pretty odd time, and you can understand why responses to that would be atypical, I think, and that we certainly found that clients that would not normally be worried about this thing, were getting more deeply worried because they just saw chaos around them.
Yeah. Okay, and maybe it relates back to that changing plans as a result of the cost of living crisis, and actually just having to create some cash to, you know, to cover bills. So I guess, or to help out family covering bills. So maybe in a number of different things going on, but I'm sure there might be some questions about that as we get to the end. The next topic we ask about in the survey is around sustainability. Alex, I'll get you to pick up these.
Yeah, so I think the trend is clear, right? And sort of, you know, do you want your fund selection, do you want your investment solution to start integrating more ESG factors across the board? And, you know, if we go back to 2019 when this all started, you can see that the sort of paradigm shift was in 2020, and that just continued to sort of hover around that area. Which sort of brings me to the way about thinking about ESG integration as well. It's going to be really difficult to manage any asset without thinking about the trends that ESG will result in. You know, very simply, we'll see productivity shift into different industries. Just pick on the automotive industry. We'll move from internal combustion into electric vehicles. If companies are not embracing this, whether you believe in ESG or not, that's happening, and you have to value that company in that fashion. And so, you know, that's what we think about when we think about ESG integration. And I think what this stat is showing is that more people are understanding that ESG factors are assessing risks of companies in very similar ways that you would do a SWOT analysis, right? Very basically. And so I think this is a positive affirmation that we are starting to understand about ESG factors are not just potentially for sustainable models or sustainable funds, but they impact most different asset classes that you invest in as well. And so we'll continue to see this trend hopefully stay here and improve as we continue to go on. Going on and thinking about sort of, you know, what are the sort of key factors that you want to start thinking about? And I think it's really positive to see that they expect investment managers to start including this in investment decision making, but not just in the fact that we have to do it, but as part of the overall risk and return aspect as well. So it's now become an integrated part of your investment decision-making process as well. And we can see that sort of at the 56% line. Again, there is a cohort of advisors want to sort of positive impact as well. But then again, you know, on the premise that it generates a good risk-reward outcome. But I think the blend of incorporating all those aspects is most encouraging. And that's definitely what we're starting to see on the top line there as well. Now, this is an interesting one, and I think it's because of the sort of backdrop of the marketplace as well. So it's no doubt that 2022 was a difficult period for sustainable funds, models, solutions. And the reason for that is because the market made money through energy security this year, right? So investing through traditional or conventional energy companies was where most of the returns were made. And so we know that a lot of sustainable solutions don't have high levels of exposure to carbon. And so for that created a headwind for returns. Secondly, they tend to be underexposed to value attributes within the marketplace as well. And value is being a clear beneficiary of a high interest rate and an energy supply side crisis. And so performance has been challenged. And therefore, I think you have this, you know, this decrease that we can see within the stats here from a year ago, that, you know, we're expected to allocate less to sustainable investments, and that's potentially, and we'll probably pick this up with Philip, but I think that's probably performance-led in a lot of aspects as well. The way I sort of think about that, and which sort of links into the next slide, is around there is a cost to transition, right? We don't just transition to net zero. It is difficult. We have to spend money to get there. And that comes from an investment aspect as well. And so periods like 2022 is our investment cost in order to set up investments for longer periods of time in order to get there. And so we can see that, you know, only a small percentage of the client base still, you know, wants to reflect ESG factors. And that's come off a little bit from the sort of traditional trend that we had from 2019. But ultimately, we're still seeing this integration. And I think a lot of it is in the near term, you know, where we've had very traditional type asset classes really generating most of the returns. But I mean, you know, it is still a small percentage, and we all have lots of work to do around this still. some of the conversations are slightly more interesting at this point as well. And I think it's again a base effect aspect. So what are you interested in discussing about from an ESG perspective? And you can see fossil fuels, why? Because we're experiencing an energy crisis, the impacts of war, clearly, because of what we're seeing on the television and the sort of inhumane aspects around that as well. And so how that relates from an exclusions aspect in your portfolio. And things like climate is moved further down. And I think, it's interesting that it's not an outright difference, but we're definitely seeing base effects based on near-term, real-time experiences that we see in our day-to-day life that we want reflected within investment portfolios as well. So seeing that balance come through in discussions is quite curious. And then around confidence, I think you can't actually be too surprised by the confidence levels coming up talking about ESG. I think the mass amounts of regulation, terminology, principal adverse impacts, task force for sustainable disclosures, SDR, SFDR, all of these aspects are making it more and more challenging for us to have ongoing conversations because the industry is still learning as we go on. And so, having to stay abreast of all the sort of terminology, the regulation, the integration, which just seems to get more and more each year at this point, I think it's not surprising. But I suppose thinking about some of the next stats with that, I do find this surprising, where we're saying we're not that confident yet to talk about it, but I don't actually want you to tell me more about that either. And so I mean, Philip, I'm sure you'll have a good comment on that one as well. But ultimately, this is where we're stuck. It's around we have to be able to be more confident to talk about it because these things are happening. But where else are we going to get that ultimately?
Well,
and then maybe now comment, Philip. That would be useful.
Well, I was reflecting earlier on this week that the biggest issue that I've come across with ESG in the last 2 weeks was a colleague discovering that extreme cold temperatures drained the battery, which has not exactly left her well disposed to a more modern way of getting from A to B. So, I mean, I think it's still there in conversations. I mean, there obviously, been quite a lot of coverage of big asset managers making big pullouts from this area as well. That has really been the first major global investment house doing an about turn, which I think is feeding through into people's general belief about it being all one-way traffic. I mean, it's never going to go away as a topic. It's obviously it's obviously going to continue to be important. I have no idea why you can illustrate that people don't know as much as they should, but yet don't want to know anymore, other than an innate desire that we either think we know it all or we haven't got enough time to stuff any more learning into our heads. But you'd expect to see that unwind over time, I would have thought, Alex.
Yeah, I tend to agree with that. And probably this year it is the consequence of a lack of time, because there has been a lot going on, to say it in the nicest of ways. And I suppose to wrap all of that up, it is definitely clear that sort of engagement and stewardship is what people are most after, and I couldn't agree more. So really taking that positive change view. I mean, divestment should ultimately be your last course of action because anything we've done in the last 10 years clearly hasn't worked. So we need to continue to drive positive change, and to do that, we need to use our active ownership votes off the back of that. And so just seeing that sort of stewardship is important. I think it's absolutely crucial to the next part of our sort of journey to decarbonize the world as well.
Agree.
So lots in there in the survey around sustainability, but definitely some interesting views being expressed and coming back to us. The question actually on one of the previous slides about client conversations around things like arms was really interesting. So maybe people's values are really being challenged with some of this stuff in terms of, I don't want to invest in arms, but we want to help in terms of what's happening with Ukraine. And I was speaking to an advisor just the other day who said that very same thing. So I've just had a letter in from a client saying, what do I do here and where do I invest and what's the situation with arms? So it's almost like deeper conversations are now taking place around sustainability, aren't they? I don't know, Philip, are you finding that different kinds of conversations with clients?
Yeah, I mean, not that specific example that you give. I mean, I can see a nightmare scenario where you're almost cherry picking portfolios to match the individual predilections of any investor at any particular point in time that then subsequently can change. I mean, I think we all know this area is really difficult and is a real minefield, if you'll pardon the pun, to navigate your way through. And that's really interesting. I've not heard that, and actually the tie into people actually wanting to support Ukraine is really interesting. We haven't seen that, but that's fascinating.
Yeah, I just thought it was interesting because we'd asked about it in the survey, and then I was in a real life conversation where an advisor was talking to me about one of his clients.
I mean, on the positive side of that, how great that client is so well engaged with what it is they actually hold and what their money's doing. That's fantastic.
No, absolutely, completely agree. And I think I agree with you on the education front. Maybe people are just ESG'd out at the moment in terms of there's so much going on in terms of just keeping pace with what's happening in markets. So we'll wait to see what happens with 2023 and sustainability, but certainly loads of different information coming through on the advisor survey that was really interesting for us. I'm just going to very quickly cover some of the advisor business challenges that we always look at in the survey, and then we'll open up to Q&A. So firstly, we always ask about the key concerns for advisors, and it's never a surprise that the top one is always regulation. And clearly at the time when we asked the questions, we've got consumer duty going on in the background. We had SDR and the product labeling, or the regulation, the proposed regulation on that, which obviously lead to sustainability conversations, but certainly lots going on. Number two was interesting because often I find that PI cover used to be number two and it's fallen away. We'll talk about that in a minute, but servicing existing clients came right back up the radar for advisors. And I guess that's back to having those client conversations about staying invested, what's happening in markets. So we've talked a lot about this in previous surveys, holding clients' hands throughout volatile times and, adding value as advisors. So that was clearly, a challenge and a concern for many advisors. But PI was an interesting one that it dropped so far down. I'm not sure of the rationale for that. Maybe we can have a chat about this, but maybe there's just simply, less DB transfers about. I saw an interesting tweet from an advisor recently who said he'd doubled his turnover, taken on an extra member of staff, so another advisor, and his PI cover had remained the same. So maybe PI has actually, started to settle down, but we can cover that in a minute or two. Maybe Philip would have a view. But speaking of consumer duty, we also asked how prepared or how well prepared advisors were. Interesting because obviously at the time of the survey, I think by the end of October, initial plans had to be prepared and presented to boards or senior management if a board's not in place. We still saw 6% of advisors not having really started to think about this yet. And 76% currently preparing plans. So a kind of mixed bag, I guess, of responses here. 18% think that they're fully prepared and don't need to make any changes. So that will be interesting to see how it plays out as we start to go through next year, where I guess more and more information will come out about consumer duty and some of the actions and activities that we all need to take, not just advisors. Segmentation is an interesting one because potentially as one of the customer outcomes, it's something that advisors might want to do in terms of delivering products and services. We started to look at this a number of years in more earnest. We have tracked it since 2014, but a few years ago we did a bit of work on prod, and as a result started to look at it and got quite excited when it reached 66%. I'm sure it wasn't as a result of our prod guide, but that would be good if it was. But it's come off right down to 58% of advisors segmenting the client base. So a reduction there. Probably what's more interesting is this next slide, where we've always asked, how do you segment clients? And, typically a couple of years ago, it was predominantly by assets under management. And that had started to drop right down in favour of life stage, which we think, and given some of the other work we've done on prod, is probably a good approach to take. However, I had one of those aha moments this time of the survey when suddenly other shot up to 40%. Now, I don't really know what this is, which is part of the fun of the survey, isn't it? Trying to interpret the data. And I'm not sure if it's just simply a combination of the first two. So advisors thinking, well, it is a combination of AUM and life stage, or maybe as advisors segmenting at a more granular level. So I'm not entirely sure. I'm always happy if you want to drop me a note and let me know what you think. But maybe that's something that we'll think about in a bit more detail. But consumer duty may have an impact on all of this segmentation piece. And then we asked about pressure on fees, where, you know, again, we're seeing an increase. 42% of advisors said, yeah, there's a downward pressure on fees. And again, it will be interesting to see how this continues to play out with consumer duty on the horizon and this whole price value debate. But what we saw was, despite there's a pressure on fees, we saw, particularly in that band of fees between 0.75 and 1% ongoing, there was an increase in terms of the number of advisors charging that from 29 to 36%. So it felt that fees predominantly were potentially on the increase, despite the fact that advisors felt there was some pressure. So some really interesting figures coming through here in terms of advisor challenges. And Philip, before we go on to outsourcing, have you got any thoughts on some of this, maybe on the segmenting and the consumer duty piece?
Yeah, so three things occurred to me as you were going through. That was quite a long section. So the PI one, I think, is interesting, but it could be to do with DB, but actually the main issue in the PI market was not necessarily its price. It was finding somebody to give you a price. It was paucity of providers. I guess the other thing you might have is an increased number that are being centrally provided through a national or a network, and therefore it's less direct issue to the underlying firm itself because it's not having to source it. The segmentation one I thought was interesting. I mean, I think the one thing that would be missing for me that would send me to other is actually client complexity, because the proposition is different for people who are more concerned about IHT solutions or intergenerational planning, or have general complexity in their finances. Now, sometimes they also have higher AUM or are further on in their life stage, but it's their complexity more than anything else that would send you to a different proposition. So that's perhaps it. Consumer duty, I happen to think, will be the single most important thing that affects our business in the next 12 months. I think that is, as you say, tied into the fee and the downward pressure on fee point, because that can be interpreted in one way as clients are asking for it to be cheaper. Another way is that we may actually stumble into a situation where a regulator that's not wanted to be a price regulator or has said it is not a price regulator is actually behaving like a price regulator. And I think there will be some people who have segments and price propositions historically, maybe they weren't even their own, they bought a business that had them, that are going to be severely challenged. I think of people taking ongoing fees and doing no more than posting out the annual report, for example. I think is going to be significantly challenged as consumer duty gets more embedded into the psyche. So it'll have a big impact.
Yeah, so it was a long section with lots in it, but some really interesting debate, I think, to be had. And a little plug for the Schroders annual conference in January. We do have the regulator joining us at that, so that will be an interesting session that we're likely to have. If we move just quickly on to outsourcing, obviously something that's really interesting for us, running as we do, Alex, the model portfolios and multi-asset funds within Schroder Investment Solutions. So we continue to ask about our advisors outsourcing, and what we've seen here is over the last year, 20% of advisors told us that they'd continue to increase their level of outsourcing. So I guess that's good news. And in terms of where that money's going, we're seeing 23% to multi-asset funds and 21% will allocate higher to model portfolios. Clearly some interesting dynamics here with the changes in CGT. Does that drive more people towards multi-asset funds? Will be one to watch. And then we've also got the proposed regulation on simplified advice. Will that also encourage more use of multi-asset funds? I think there's a number of different dynamics that could shape this as we move into 2023. Is there no real change to the reasons why, the relative importance of the factors that would lead to a decision towards outsourcing? So access to investment expertise, expect effective volatility management, no surprise given what's happened in the last year, and also improved operational effectiveness. But clearly more time to spend with clients is also important, as we looked at earlier, in terms of, one of my challenges is servicing existing clients. And similarly, in terms of the factors that contribute towards selecting an outsourcing provider, performance and cost always rank high in terms of both model portfolios and multi-asset funds. But we did see investment process coming through, particularly in multi-asset funds. And is that investment process clear, simple, easy to understand and discuss with the client? So I think there's a number of broadly similar, but maybe a few things coming through that were of interest, certainly to us. I think what I'll do is I'll just go on to wealth transfer and then we can pick both up together, Philip. Is that okay? Unless there's any particular you want to pick up on outsourcing.
No, don't think so.
Okay. So lastly, wealth transfer, as many of you know, one of my pet favourite subjects. So we like to ask a few questions on this. This was a really interesting one for me. We asked about advisors being concerned about losing business as a result of wealth transfer, and that's increased 5% between May and November. So nearly 60% of advisors now saying, well, yeah, I am starting to be a little bit concerned about losing business as a result of wealth transfers taking place. However, despite this, we still see that the average age within client banks is relatively high. And that doesn't really change significantly, or hasn't changed significantly over the last 5 years. So still this focus on typically older, wealthier clients rather than dealing with that next generation that will, inherit wealth. However, 26% of advisors are telling us that they have a proposition in place, to target wealth transfer to the next generation. Although it is only 26, so maybe that could be a little bit higher. We continue to track this number to see how it will change. I think what is interesting is that despite the fact that advisors are saying that they are concerned about losing assets as a result of wealth transfer, we're seeing now a reduced focus on younger investors. It's dropped to 14%. And very interestingly, the number of advisors really focusing on retaining and maybe attracting and advising women, particularly divorced or widowed, has dropped to 5%. Now, many of you might have heard me quote the statistic that by 2025, apparently 60% of the wealth in the UK will be in the hands of women. So with that in mind, it's interesting that only 5% of advisors seem to focus on this. We can maybe talk a bit about that. And I guess a really interesting one for me that, we researched this obviously before the simplified advice proposals came out, and the minimum asset size for advisors before they will work with a client. So we ask how many advisors will work with clients with less than £50,000 to invest. And again, that has dropped to an all-time low now of only 32%. And it's dropped quite significantly. If you look at those numbers, over the last 3 years, it's dropped by 20%. So again, it's back to the wealth transfer story. If we're really focusing on that, are we genuinely dealing with that next generation who are typically, have a lower value in terms of assets and are younger? So certainly some interesting areas to talk about. Philip, have you got any views on some of this information on wealth transfer or also on outsourcing?
Not in terms of how the trend's going. I mean, I am quite surprised actually that there is such a sharp diminished focus or expressed focus on looking after divorced or widowed partners. I mean, I think I made this point when we've looked at this survey before that I think part of this is about new business generation, but an even more important part of it is protecting what you've already got. And if you don't have strategies in that space, then you will lose assets and you will lose value in the business. And if you're running your business to get capital value, that feels very short-sighted to me. It's quite a shocking number that only 1 in 20 people are actually actively considering that part of the market, knowing what we know about the likelihood of assets going if there isn't a relationship there.
Yeah, it was a really interesting one for me, particularly around women. And then also this number here in terms of number of advisors dealing with these potentially lower value clients. So some really, yet 60% of advisors are saying, I am concerned now about losing assets from the business and therefore, to your point, losing value. So definitely some interesting areas that we've covered in the advisor survey for this year. Andrew, I'm just going to hand over to you now and stop sharing for the Q&A.
Oh, we lost Andrew. I mean, I'll maybe start off then while Andrew's just coming.
Sorry,
here he is.
Here he is. So, I mean, one question I had, Alex, is what do you think will be the single most important investment theme next year, or the single most important aspect that will affect the sorts of decisions you're taking next year?
Yeah, it's a good one. And so we've been doing a lot of thinking around sort of 2023 outlook. What are the key telltale signs that we're looking for in the market to really position the portfolios? And I think the number one theme is always we build the portfolios diverse to make sure that they sort of weather the storm. But I think a lot of the interest rate sensitivity is now sort of baked into the price. So, a lot of the bad news around interest rate increases have now come through. And, I couldn't help but sort of the flicker in my laptop screen here telling me that US CPI was only 7% now, right? That again is showing that this is sort of rolling over, and we've seen some sort of peak in the back of that as well. And so I think interest rate sensitivity is gone. And so fixed income is probably in a better place. What I'm not convinced that the market is priced in yet is this earnings recession, right? So we keep talking about all the difficulty about the consumer, the cost of living crisis, the increase in costs, but yet companies are still expected to make money next year. And that just doesn't tie up. So what we'll be on the lookout for is we'll be looking out for earnings to trough a little bit further. And so history is showing that you want sort of 10 to 20% decrease in earnings expectation. Once we see that, the market will be able to get a feel for how deep the recession could look, and we can then start pricing risk assets going forward again. And what's interesting is that, as you'll know, is that the market will bottom before earnings bottom because it is forward-looking in nature as well. So I think that is going to be the single most important thing for next year is where do we see earnings go, how far do they go, and when do they hit a trough?
Yeah. Well, another question here along those lines, Alex, the question is the UK equity market now undervalued and offering good buying opportunities over the next 12 months, or should it be avoided?
It is as cheap as it's ever been, and if not more, but arguably for some reasons though as well. And so I think we structurally own UK equities. We've made a good return out of UK equities this year. I think it's been one of the better performing markets. I think there is still uncertainty around how bad the trade deficits look post-Brexit world, and that's reflected in the discount. And I think that's what you're seeing there. I think we saw a big risk to the fiscus in the terms of the change in leadership, circa 4 times, which didn't build confidence for international investors. So we do need a little bit more evidence of continued policy, the right continued policy, budgeted continued policy, to be absolutely clear, just in case anyone's listening, and then to make sure that we can then sort of price that in going forward. So yes, it's definitely from a valuation perspective, it's attractive, but it is attractive because there are some reasons for that as well. But I wouldn't discard it from your portfolio now.
Okay, thanks, Alex. Moving to the other side of the presentation now. Somebody's asking the question, is there a slide? I know there isn't a slide, but do you have any sort of further information around the age profile of clients asking for ESG type funds? And this particular advisor is saying that, in their experience, this is of greater interest to younger clients. Perhaps Gillian and Philip, I could ask that of both of you.
Well, yes, typically we've seen through our global investor survey, so where we can actually isolate the UK data as well as look at the global picture, that it is typically younger people. But actually, I think what we're seeing is a trend shifting to a more broader base, actually. And some of the other interesting factors from the global survey is we also see that there are more women So back to that point on, advising women and thinking about that transfer. So more women are typically interested in investing in a sustainable way. But no, we can certainly pull out the stats for anybody that's interested.
Yeah, I mean, mine would be anecdotal, not statistically based, but every advisor that we have will have a grandparent who has been badgered by their grandkids to start thinking differently about how they invest. So that, I think that's how it starts to transcend different generations.
Okay, we've got about 5 minutes left for Q&A, so do please type in your questions in the chat function. I've got a couple here, and I'm sure Philip might have one or two as well. Before we just move on, one final request. We obviously do want to make sure that we send you all your CPD. And as I look down our list of participants here today, I can see one or two of you where perhaps you've just got one name, or not your full name necessarily, against your screen icon. You should probably have received, if you look in the chat function, if you are one such person, you should have received a message from my colleague Joe, just asking if you could identify yourself. We need that information in order that we can send you your CPD. So if you want your CPD, quite simply, just tell us who you are, and we'll take care of that. Another question that's come in the current climate. Where do you see the obvious opportunities for advisors and their business growth? Gillian.
Oh, wow, I thought you were going to throw that one at Philip, actually.
Well, he can follow up on that, but I wonder.
I guess it depends. Well, as you know, my view's always been in terms of growth for clients is this whole focus on the next generation, but that's about retention as well as growth. And I think what we're also seeing is, the next generation isn't getting any younger, and there are definitely, advice opportunities. We did some research a number of years ago into millennials, and at that point, the top age of the millennials was 36. They're now about 40, right? But what these, and we grouped them in that older cohort of millennials, we're saying we absolutely want to start to think about long-term savings and investment, and in particular pensions. So I guess it's looking within the client bank and seeing, are there opportunities to advise that next generation? And if so, what's the proposition that I need to put in place? And what are some of the things that are stopping me from doing it? The two points I always hear from advisors is, I won't make profit, and I don't have a proposition. And I think there are opportunities if we sit back and think about how it could work, and how do we use technology to deliver light touch, lower cost propositions? How do we charge differently? Do we need to offer mortgages and protection, which many advisors have moved away from? So, I do think there's opportunities for growth, often starting within the client bank. Also, actually, in the women's piece, if we go back to that, we know that according to research, 70% of widows will change advisor at the point they inherit the wealth. Now, that's a threat, potentially, but my goodness, what a great opportunity, isn't it? If you're an advisor that actually holds yourself out as we're specialists in advising women, particular widows, thinking of that baby boomer generation, what a fantastic opportunity, because 70% are going to go somewhere else. So there you go. There's my couple of ideas. Philip might have something different.
No, well, not necessarily different. I mean, I think the single biggest opportunity for advisors next year is to be able to go back to the plan that they had 2 years ago, and not be derailed by two Fruit Loops, one in charge of the country and the other in charge of the Treasury. I mean, it just caused absolute mayhem for anyone involved in interfacing into clients. It just was utterly counterproductive. We all know the reasons of what it did to the economy, but in terms of taking your eye off the ball of the things that you were doing well, keeping in touch with clients, helping them through concerns about a wider, economic situation more globally, it just ended up, in an entire panic situation for a period of time. And that's on the investment side. Imagine what it's like on the mortgage side, where everybody's scrabbling around trying to secure deals before they go off, really hit the panic buttons in terms of, closing out of deals that people already had. I mean, just in general for our industry, it was an absolutely catastrophic period, and it would just be nice to have a period of relative stability. I think the opportunities remain the same as they always were. We're an undersupplied industry with far too few advisors in a world of tax wrappers and advice need that is getting ever more complex, not less so. So that will always carry on. And I'm actually quite heartened that millennials are now 40, because it feels like there's another cohort of undersaved people and under-advised people to, for us to engage with.
Good, Philip, thanks very much for that. I'm just looking to see if there's any further questions. No, there aren't. We've got about 4 or 5 minutes. There are 40 odd advisors on the call just now, but some of you are being a bit shy perhaps. So Philip, I'm going to ask you if you'd be the team captain for the advisor side, and if you have any further questions for either Gillian or Alex.
Well, I'll pose one to Alex, so maybe pose one to Gillian. I mean, you've now got 8 years worth of data. Which element of these statistics do you think is giving you the starkest difference 8 years on from where we are? And I guess the corollary to that question is, do you think that's an improvement or a detriment to the position of 8 years ago?
Is that relating specifically into the survey data as well?
Yes, yeah. Which is the starkest trend, would you say, and is that for good or for ill?
I think the consistency in most of them is quite helpful, right? Because I think if it wasn't that, then we'd be seeing even more flip-flopping, which, my biggest concern from an investment aspect is the difference between investment return and investor return. And you'll know better than anyone, Philip, that the delta of that is behavioral bias. And if we're seeing a flip-flop in the data, that means that people are sort of capitulating at probably the most wrong times, right? And so ultimately, that's quite comforting. And I think if we're to start seeing a reversal in some of that, the detriment would probably be investor returns relative to investment returns. So that's useful. And then I think the second bit that's quite useful is obviously gauging where we can help more, right? So understanding, fund managers are very, very comfortable to always think they know what people want to hear, but we don't, right? And so actually hearing it from people as well is very helpful. And to say, are we focusing our energy in the right direction to really support advisor businesses as well?
And Gillian, more broadly, out for the trends outside investment ones, which one do you think is the most stark? Same question, I guess.
Yeah, it's a good question. I was madly trying to think there. I think what was interesting for me, particularly this time, is about the number of advisors that are outsourcing. And that's dropped in terms of the numbers that are not outsourcing and building themselves. That's dropped to only 20%. Now, we always used to talk about 50% of the market are building their own portfolios and 50% are outsourcing. If you look at one of the slides that's in the pack, it shows that only 20% are not outsourcing any client money. Now, that's a massive reduction, I think, on where we've been in previous years. We can all look at some of the rationale for that. And I do wonder as well if consumer duty will have an impact. If you think about it, we now, as model portfolio providers, we now have to do things like assessment of value because we're caught under consumer duty as providing a service. So assessments of value, target market documents, all of that governance, which we do anyway, but we have to do more of it. So for those advisors who build their own model portfolios, will that become an additional factor in their decision to actually continue to build models or to start to work with a number of investment partners? So I think that was an interesting one for me this time round. It seemed to reduce. And I'm just going to pick up, if I can, Andrew, I might beat you to it, but I noticed a question about the research. And yes, we're happy to share both the slides from today, but also there's a report that will make sure that you get made available that covers both the output, the results themselves, and our views on it.
And what we'll try to do when we send you your CPD and a link to the recording of this event, we'll speak to Schroders straight afterwards, and we'll get you either a link or the actual document that we can send through to you at the same time. Another question that's come in, when will the banks and the companies, and life companies waken up to the orphan clients that are not being serviced and haven't been since the mid-2000s and badly need being serviced? Who wants to pick that one up?
Do you want me to start that?
Well,
invariably they pick it up when they sell their own back book and try and realise value from it. It tends to be the first time, it's properly addressed. I'm not sure if you're meaning specifically those circumstances where the life companies also had an advisor base itself and they weren't being looked after. But certainly for our business, that has got a considerable legacy back book. We do continue to service them and we do continue to engage with them. So I think the market probably splits between these two different these two different parts. Obviously, the proposed changes that the regulator came out with 2 weeks ago about making it more straightforward for up to a 20 grand ISA to give that advice is going to, I think, lead to an awful lot of providers dusting off some of their old business plans now that their big objections around risk and control have started to be addressed. So I think you'll see continued interest in that as an opportunity rather than anything else. But that's my personal view.
Okay, thanks. Gillian, I'll have to hurry you, but quick view.
No, I would just say exactly the same as Philip. I was also going to pick up on the proposed regulations and whether or not that plays into the opportunities that, for example, the banks must have in terms of identifying clients that are holding too much in cash, which is what this is all about. And thinking of the vulnerability, all right, cash rates are up, but so is inflation. So it's the interplay of the two. And if the regulator is identifying that some clients are doing harm by not investing, then clearly, the proposals are an interesting way of trying to take this forward.
Yeah, it's clear there's an ever increasing amount of work to be done in that ever larger area as well, isn't there? Well, look, I'm afraid we're out of time. Thank you, Gillian, Alex, and Philip. There was a really fascinating session. Thank you for your insights in what was a reasonably lively Q&A in the end. If your question wasn't answered in the time available, don't worry. We'll send it to the good folks at Schroders, and I'm sure that they'll respond to you personally. Before we wrap up, let's just take a quick look at those learning objectives again. Hopefully now you understand the views on the investment market in October, November 22, how they've changed and future predictions. We've discussed the importance, of course, of ESG factors when selecting funds and clients' views on sustainable investing. And finally, hopefully you understand the potential in relation to wealth transfer, advice fees, segmentation, and succession planning as we move into 2023. Almost there. Before we sign off for Christmas, just let me tell you about our schedule of events for the first quarter of 2023. We're only 3 weeks away. We're straight back into action with our very popular working lunches on the 18th of January, when Baillie Gifford will be our partners once again. With the growing importance of ESG across the investment landscape today, Client Director Seb Pettit will be discussing the long-term prospects for their Responsible Income Growth Fund. For those of you who like to shake speakers' hands at live events, our first roadshow of the year will kick off in Harrogate on the 24th of January, where multi-asset and MPS strategies will be on the menu. You'll hear presentations from Orbis, HSBC Asset Management, Morningstar, LV, and a couple of others to be announced over the coming days. After Harrogate, we'll be in Warrington on the 25th of January, Birmingham on the 26th, and then the following week, we're down at Bristol in Lee Court on the 1st of February, and we'll wrap up the roadshow in London on the 2nd. On the 8th of March, our working lunch partners will be Baillie Gifford again, and we'll be providing details on the content of this event in the new year. Now, there was some talk about consumer duty and people's preparedness for it a little earlier in the presentation. I'm sure many of you are still concerned about being ready for consumer duty next year. And in recognition of this, we've pulled together the 3 largest support services groups, Sesame Bancorp, Simply Biz, and 360, who are going to help us deliver an online consumer duty coaching masterclass over 2 days in March. And we're still working on the exact details of how this is going to manifest itself. So keep an eye out, please, on the Professional Advisor website. You will, for those of you who need just that little bit of extra help to get you over the line, I'm sure you'll find this useful, and you'll find details of how to register for those events in the coming days and weeks on our website. So all in all, that's a total of 10 hours of CPD for you in the first quarter of next year. So that should get you off to a cracking start. So that's it for today's session. All that remains for me is to thank our speakers, Gillian and Alex from Schroders, and to Philip from Unique Financial Planning for a really insightful and interesting session. Of course, our biggest thanks, as always, go to you, our readers, for your company this lunchtime. I trust you found the past hour helpful and worthwhile. For now, then, let me wish you a very happy Christmas, and we very much look forward to seeing you again in the new year. Goodbye.